Today, another topsy-turvy day. Hello again, it's Martin North from Digital Finance Analytics, World Notice Post, covering finance and prop news with a distinctively Australian flavour. Well, Monday was a down day on Wall Street, with the main indices lower, as investors digested comments from the US Federal Reserve officials about plans for interest rate hikes. Losses accelerated toward the end of the up and down session, with the focus turning to Tuesday's Producer Price Index report, and markets, of course, highly sensitive to inflation data. Real estate and discretionary sectors led broader declines. The Fed Outings included Christopher Waller on Sunday, who said the Fed may consider slowing the pace of increases at its next meeting, but that should not be seen as a softening in its commitment to lowering inflation. Monetary policy tightening isn't ending in the next meeting or two, he said. And Fed Vice Chair Lael Brainard, who signalled that the central bank would likely soon slow its interest rate hikes, added that there was still additional work to do on raising rates. So there is still a sensitivity to Fed speak. One was a little hawkish, one was a little dovish, said Eric Kuby, Chief Investment Officer at North Star Investment Management. Markets here are starting to really factor in the top of the Fed's cycle, said Sean Osborne, Chief Foreign Exchange Strategist at Scotia Bank in Toronto, pointing to last week's US inflation reading as solid grounds to believe it can move lower. Ahead of himself, I think. So the Dow Jones Industrial Average fell 0.63% to 3,536. The S&P 500 lost 0.89% to 3,957, and the Nasdaq Composite dropped 1.12% to 11,196. This, of course, is all in the context of the S&P 500's last weekly post, which was the weekly percentage gain highest since late June, while the tech-heavy Nasdaq notched its best week since March. More Fed officials are due to speak later this week, along with more data, including retail sales and housing and earnings reports from major retailers. It just makes sense the market wants to pause and really try to make sense of the trajectory of the Fed policy and what the next drivers are going to be, said Young-Yu Ma, Chief Investment Strategist at BMO Wealth Management. Among the S&P 500 sectors, real estate fell 2.7%, consumer discretionary dropped 1.7%, and financials declined 1.5%. In company news, Amazon shares fell 2.3% as the New York Times reported the company was planning to lay off around 10,000 people in corporate and technology jobs starting as soon as this week. Healthcare, a defensive corner of the market, ended the day just above the flat line, with Moderna and Biogen leading to the upside. Shares in Biogen and Eli Lilly gained around 3.3% and 1.3% respectively after the failure of Swiss rival Roche's Alzheimer's disease drug candidate. Moderna jumped more than 4% after reporting that its new COVID-19 boosters provided increased protection against Omicron subvariants than its original formula. Tech, meanwhile, was mostly lower, pressurized by more than a 2% decline in Microsoft and Meta platforms, but the trend rising more than 1%. Advanced Micro Devices reversed some early day gains and ended 1% higher after receiving an upgrade from Baird and UBS. UBS upgraded AMD to outperform from neutral and lifted its price target on the stock to $95 from $75 on expectations that demand for chips is set to resume as the glut in chip inventories is nearing a peak. Energy stocks shrugged off a slump in oil prices after OPEC cut its estimates on global oil demand amid a weaker economic backdrop. Valero Energy Corporation and Chevron led the gains in the sector. On the earnings front, oat-based drinkers maker Oatly reported a larger than expected quarterly loss as revenue fell short of Wall Street estimates, sending its shares more than 12% lower. Gold was at $1,775, while the 10-year Treasury rose 0.89% to 3.868, and the 2-year was up 1.69% to 4.3993. The US dollar gained against the yen and the euro on Monday, but pulled back from its heights of the day, with investors betting on a slower pace of Federal Reserve rate hikes going forward. The dollar index was higher after falling 4% last year, marking its biggest weekly drop since March 2020. After that data showed US consumer prices rose less than expected in October and prompted bets for slow hikes. It rose as much as 0.93% to 107.27 before it pulled back to around 0.55% at 106.88. The euro was last at $1.02. The euro was last at 1.0326 after earlier rising to a 3-month high of 1.0368. ECB board member Fabio Patena said on Monday that the central bank must keep raising rates but needs to avoid over-tightening, as doing so would destroy productive capacity and deepen economic slowdown. Data showed on Monday that the Eurozone industrial production numbers rose much more than expected in September, and output for August was revised upward too. Economists said that might be partly due to manufacturers front-loading production before energy-related disruptions this winter. Sterling fell ahead of British Chancellor Jeremy Hunt's autumn statement on Thursday, when he's expected to set out tax rises and spending cuts. The pound was down 0.55% at 1.1770, having risen 4% in the previous two sessions, touching on Friday its highest level since late August. China's onshore yuan rose to nearly a 2-month high against the dollar, coinciding with its central bank's official guidance and a broad lift in Chinese market sentiment on moves to help its embattled property sector and a decision to ease some of the country's strict COVID-19 restrictions. And elsewhere, the dollar was up last at 0.79 against the yen at 139.94 after rising as high as 140.79. The risk-sensitive Australian and New Zealand dollars regained some lost ground, and the risk-sensitive Australian and New Zealand dollars regained lost ground after earlier slipping sharply against the greenback. The Aussie was last at 67 cents. China's rule by law, where the legal system is used to exercise government will or make changes to just about anything at any time, was at the oil market's forefront again on Monday as Beijing attempted to convey a more flexible attitude towards COVID, juxtaposed with an explosion in new infections from the virus. Crude prices tumbled actually more than 3% on the day, exhibiting again the volatility that's frustrated oil bulls so much since last month. After OPEC's bid to bring a barrel closer to $100 with the sharpest production cut in 2 years being watered down by, firstly, the lockdown, by one lockdown after another under a zero-COVID policy in China. That's, of course, the world's largest oil importing nation. New York traded West Texas Intermediate, or WTI, for delivery in December was down 4% at 85.21 per barrel, wiping out Friday's 3% rally, which was spurred by a move to reduce the quarantine period for travellers in China and the scrapping of major restrictions on international flights. WTI ended last week down 6.6% after back-to-back wins of 5% and 3.5% in the two prior weeks. And London traded Brent crude settled down 3.6% at 92.52. The global crude benchmark fell nearly 3.5% last week after gains of about 3% and 2.5% and 2% over the three prior weeks. China reported 14,288 COVID cases on Saturday alone, up from a nationwide tally of 11,323 on Friday. Daily cases have stayed around the 10,000 level since reaching that last week for the first time since April. And Guangdong, Henan, Beijing, Xinjiang and Inner Mongolia remain the provinces or municipalities with the most outbreaks. China just relaxed some pandemic measures, but experts suggest zero COVID probably won't be going any time soon, Time magazine said in the focus piece. Matthew Bosens, a Shanghai-based editor and journalist who's lived in China since 2014, said, "I've had dozens of nucleic acid tests, cancelled a domestic work trip, and seen multiple colleagues hauled off to quarantine hotel or locked down at home. Both since students in many cities in China are back to remote learning. My 5-year-old daughter is on her second week off school after her kindergarten closed due to restrictions related to COVID-19. At this point, she spent more time at home in 2022 than in the classroom." And he also said restrictions at a moment's notice had made it nearly impossible to plan more than 20 minutes ahead of time. This is bad for business, of course, but it also affects ordinary people's ability to go about their lives. You never know when you might get locked down in your apartment, workplace, a local mall, or even Shanghai Disneyland. China is the world's largest importer of crude. Last year it imported 11.8 million barrels per day, outpacing the United States, which takes in 9.1 million barrels. Back in May, as both WTI and Brent hovered around $100, the rally in oil came to a screeching halt after Beijing adopted a zero-COVID strategy and announced strict containment measures that included major lockdowns. The restrictions also had a severely negative impact on Chinese consumer demand and manufacturing output. Leon Lee, a Shanghai-based analyst at CMC Markets, said the oil market has been too optimistic lately over China's reported reopening from lockdowns. The virus will spread faster in winter, and the rapid growth of cases makes it impossible for the Chinese government to adjust the zero-COVID policy, Lee added. Moreover, it will take some time from the release of the policy to its implementation, so China's full liberalisation may have to wait until the first quarter of next year, which means that the rebound of oil prices last Friday was unsustainable. China's demand for oil from the world's top exporter, Saudi Arabia, also remained weak, as several refiners have asked to lift less crude in December. The latest easing in quarantine requirements is certainly a step in the right direction, but the market will likely need to see further easing if this recent enthusiasm is to be sustained, ING said in the note. OPEC on Monday cut its forecasts for 2022 global oil demand growth for a fifth time since April, and further trimmed next year's figures, citing mounting economic challenges including high inflation and rising interest rates. Oil demand in 2022 will increase by 2.55 million barrels per day, or 2.6%. That's down 100,000 barrels per day from the previous forecast. The world economy has entered a period of significant uncertainty and rising challenges in the fourth quarter of 2022. OPEC, known in full as the Organization of Petroleum Exporting Countries, said in its monthly report, downside risks include high inflation, monetary tightening by major central banks, high sovereign debt levels in many regions, tightening labour markets, and persisting supply chain constraints. Completing a perfect storm for oil bulls was the Energy Information Administration's update on US drilling on Monday, which projected record high output in December for the Permian Basin. That's the most prolific American shale patch. And finally, in cryptocurrency-related news, Binance, the world's largest exchange by trading volume, said it will launch a recovery fund to cash-strapped crypto companies starved of liquidity in the wake of the collapse of FTX. But cryptocurrencies remained in turmoil after the fall of FTX. The crypto exchange's token was down 7.8% on the day at $1.308, representing a 95% drop on a month-to-date basis. And Bitcoin fell as far as $15,784 earlier on Monday before recovering somewhat, and it was last at $16,433 US. So once again, more turmoil, more volatility, and expected to continue into the coming weeks and months. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer.